This brief video highlights various topics included within our 4-day blended training workshop on problem loan management. The course provides a comprehensive understanding of essential problem loan management concepts, tools, and techniques. The program entails 4 modules. Each module includes a remote session and e-learning activities. Participants can discuss topics and concerns during the remote instructor-led sessions, exchange thoughts, share experiences with the instructor and peers, and receive constructive feedback in a supportive environment. The remote sessions are supplemented by e-learning activities involving videos, handout, quizzes designed to improve understanding and retention. This training course reflects our experiences in delivering similar courses on problem loan management in Cambodia, Ethiopia, Jordan, Kenya, Lebanon, Mongolia, Nigeria, Serbia, Tajikistan, Tanzania, Ukraine, and Uzbekistan. Though information may not yet be on the front pages, banking professionals, regulators, international financial institutions, and development finance institutions see and understand the impact of COVID-19 on the portfolios of financial institutions globally. Furthermore, as the stimulus and relief packages expire, the extent of the COVID-19 impact on the financial institutions' portfolios and government budgets will become quantifiable. Seasoned lenders and entrepreneurs understand that economic turbulence and macroeconomic shocks are ongoing market occurrences which will result in financial institutions being exposed to upsurges and non-performing loans. This undeniable and unavoidable fact is particularly challenging in markets lacking a long history in problem loan management. Thus, problem loans are a byproduct of the lending process. We cannot eliminate problem loans. If an institution is going to lend money, it should expect some level of problem loans. Problem loan management entails developing the strategies, policies and procedures, and internal capacities required to enable financial institutions to keep problem loans within reasonable or manageable limits. The course is entitled Problem Loan Management because a practitioner with hands-on workout experience developed it. One of the goals is to highlight the importance of the definition of problem loans. The definition of problem loans is essential because it drives our actions. Also, the description should facilitate and require early recognition. Therefore, we encourage lenders to consider defining problem loans as loans that are not being repaid as agreed, loans to companies with financial problems, and loans for which repayment risk has been identified. Please notice, this definition includes loans currently being repaid as agreed, but continued repayment is uncertain. We recommend lenders focus their attention on managing problem loans instead of non-performing or non-accrual loans. By focusing on problem loans, lenders are required to identify problems earlier rather than later. Accordingly, the recommended definition requires lenders to designate a loan as a problem even if the obligation is currently being repaid. Frequently, success in managing problem loans comes down to a matter of early recognition. That is, the earlier a problem is identified, the easier it is to resolve the issue. Once a loan is designated as non-performing, or once there has been one or more payment default, the odds of full repayment declines substantially. Throughout the program, we stress the importance of proactive strategies. Proactive strategies should be implemented during quiet times, not during a global pandemic, given the priorities and dedicated staff time required to implement the strategies. However, we concede that implementing the strategies later is better than never. Proactive strategies include such portfolio housekeeping activities as reviewing the accuracy and completeness of the financial institution's information systems, to accurately track entire relationships, including related companies and their outstanding principal, interest, and fees. Reviewing the financial institution's early warning indicators and response procedures to ensure appropriateness, staff's understanding, and compliance. And pruning the loan portfolio of more susceptible accounts. These activities should be completed before the first signs of a looming financial crisis. Doing so enables the financial institution to reduce institutional and system blind spots before a financial crisis unfolds, thereby enabling management to protect shareholder value during difficult times. Typically, during a financial crisis, the staff does not have the time to carry out the broader information gathering needed to improve portfolio monitoring and response. Also, during a financial crisis, management frequently views these activities as diverting attention from resolving problems as costly distractions. Inadequate information systems stemming from rapid growth can result in fragmented information that lacks data integrity controls. Having up-to-date and accurate loan portfolio information during a financial crisis is indispensable. We ask the participants to consider the big picture. That is, what are we doing? What are the situations, the tasks, and the goals? Also, how should we measure success? We discuss problem loan management because there is an existing or perceived problem or default, either payment or technical. Thus, we are dealing with a troubled loan or relationship. From a big picture perspective, we are trying to correct, mitigate, or avoid a problem or a perceived problem, loan, or relationship. Given the importance of early detection, we ask the question, what drives a company to default on its payment or declare bankruptcy? Is it an issue of leverage? Is it an issue of profitability? I would say no. It is an issue of liquidity. That is, the borrower does not have the cash to make the current payment that is due. Wouldn't it be amazing if we could profile companies to identify and evaluate payment or liquidity risk without relying on the borrower's financial statements, which prolongs the time to discover problems? Though it would be great, profiling a problem company is complex because problem companies vary significantly in terms of size, industry, geography, and stage of business life cycle. Consequently, we discuss 3 conceptual phases of a company's liquidity instead. Phase 1 is considered the earliest and least severe phase, while Phase 3 represents the most advanced and critical phase. We explore issues and events that might indicate a borrower is operating within one of the 3 phases. Phase 1 would indicate that management makes cash management a priority, while Phase 2 would suggest that cash management has become the top priority, whereas Phase 3 would imply that the company is in a do-or-die situation. Thus, the company must take drastic measures to ensure survival. In discussing this approach, we emphasize the benefits of thinking in terms of the phases of a liquidity dilemma. That is, overdrafts and past due loans typically do not occur until other creditors, for example, trade creditors, have suffered and other emergency measures have been taken. So, what's the risk if we cannot recognize the various stages? The risks include other parties, creditors, whose interests are subordinate in liquidation are paid from the proceeds of assets that are pledged to senior lenders as collateral, and financial resources may be diverted to pay suppliers and other creditors in response to pressure. As a result, resources are not available to finance a constructive workout plan. The goal is to promptly identify the phase that the company is operating within, thus ensuring that corrective steps can be taken quickly and adequate resources are available to finance a constructive workout plan. As you consider the various phases of a company's cash dilemma, it becomes apparent that the lender is frequently the last to know about the cash problem, especially if the lender is using lagging indicators such as payment default to detect problems. Suppose lenders act only after being impacted, payment default for an example, those lenders focusing on managing non-performing loans. In that case, they are not operating in the best interest of the institution and in the best interest of the shareholders. Let's revisit the big picture questions we asked. Notably, how should success be measured? It is essential to discuss measuring success pragmatically. Otherwise, how do we know if we are doing a good job, or when we should stop, or when we must continue? We pragmatically discuss the objective of problem loan management and restructuring loans. When managing problem loans, the objective is to improve the bank's position. This objective applies to large corporate, commercial, SME, and retail problem loans. How do we improve the bank's position? The answer is straightforward. We improve the bank's position by reducing exposure, principal or interest, or increasing collateral. Thus, we measure success by considering the objectives of improving the bank's position. It is essential to understand that a slash and burn approach, for example, immediately liquidating assets, may not always produce the best recovery for the lender in the long run. As assets are liquidated, the borrower's ability to generate cash in the future is eliminated as well. One of the first questions often asked is, why consider a workout? Why consider restructuring a loan to a problem borrower? Why should we exchange a new promise to pay for the old commitment which the borrower did not uphold? There are two pragmatic workout rules of thumb that I follow. If you cannot improve your position, don't do it. And never give anything away. Always trade up. The fundamental reasons for considering a loan restructuring or workout includes improving the documentation, obtaining additional collateral, eliminating borrowers' defenses, and positioning for payout. As lenders and humans, we understand the difference between working with cooperative and uncooperative borrowers and people. We all acknowledge that cooperative borrowers are easier to work with than uncooperative borrowers. During the program, we explore a procedure for selecting strategies for working with cooperative and uncooperative borrowers. Two fundamental credit variables guide the approach: the borrower's viability and the collateral adequacy. Thus, the strategy used when managing the troubled borrower is based on whether the borrower is cooperative or uncooperative. Some people find the negotiation process most stimulating, and others find it to be the worst part of the job. We tell the participants, whatever their view might be, don't take it personally. Understand that negotiations are part of the process and part of the job. Consider yourself an actor with a role to play. Play your part well. Be professional and try to enjoy yourself as much as you can. Since the negotiations are a critical aspect of the restructuring process, we must take it seriously and conduct ourselves professionally, which involves planning and preparation. At a minimum, the preparation required to negotiate effectively includes understanding your institution's policies and procedures, establishing your institution's objectives, assessing the negotiating leverage of the various players. For an example, who has the most significant influence, the bank or the borrower? Determining the minimum acceptable terms and conditions, and establishing and stipulating the negotiator's authority to commit the lending institution to the approved terms and conditions. We also discussed the process of assessing negotiating leverage. Negotiating a loan restructuring necessitates a candid assessment of the parties' relative strengths and weaknesses. Therefore, conducting a SWOT analysis is appropriate and required. When performing the SWOT analysis, our goal is to consider the following viewpoints: lender's strengths, how to capitalize on them; Lenders' weaknesses, how to minimize them. Borrowers' strengths, how to use or negate them. Borrowers' weaknesses, how to use them. Thank you for viewing this video. Our goal was to provide an overview of the topics presented and the pragmatic approach we used in delivering training programs. If you want to learn more about this and other training programs offered by GBRW, don't hesitate to contact us via our website. We will respond promptly. Our website address is www.gbrw.com. Thanks again.